there will be some little corrections and all that. So it is just a minor errors, right? Of which we can actually adjust it, right? Maybe in our intensive class. So yes, there are some questions that we will not even do in class. We'll attempt those questions in intensive when we start intensive class, right? But for now, please attend to those questions, right? It is very, very very, very important. Good afternoon, professional colleagues, once again. So please, we'll start our lecture at 12:10. So before we start, please, do you have anyone that have question? If you have question, quickly unmute your mic, quickly. Please, if you have question based on our previous lecture, if you have question, please kindly unmute your mic, then ask your question. Okay. You're all welcome to Next Gen Professional Associates. For those who are just joining us for the first time, my name is Ibrahim Akindele, and I will be taking you just 70% of the syllabus of strategic financial management. So you are welcome to Next Gen Professional Associates. In today's class, we shall be looking at one of the questions on cost of capital class. This question is also adopted from Ican as well as ACC and some other relevant tests for that. So please pay attention to the details. If you look at this question, you can check examiner comment. I forgot the year. All right. If you check examiner comments on this cost of capital question, somehow. But guess what? We will unlock some of these terms here, right? Now, please, can someone read for us? Who will volunteer? Hello, who will read? Away. It seems I'm the only one in this class. Probably the 31 participants are AI. I'll be 30 participants.
Okay, let me read.
Okay. Okay. So, thank God. You are not AI.
Okay, requirement.
Okay.
Calculate the market value after tax weighted average cost of capital of JP, explaining clearly any assumption you made. 10 marks.
Thank you. Hold on. Can you see? Calculate the market value. I have said it in our previous lecture that they will use different English, whether market value, whether post-tax, after-tax, weighted average cost of, whether anything. Weighted average cost of capital is weighted average cost of, in as much that you have considered your tax in the calculation of debt. And when you want to calculate your weighted average cost of capital, you've also include market value. So it is any English, either post-tax weighted average cost of capital or market value weighted average cost of capital, right? And explain clearly any assumption you made. Well, if you make any assumption, like I said in our previous lecture, that assumption is actually allowed, right? Assumption in even in finance, right, is allowed. When you want to do a financial modeling, you assume some index, some inputs that, okay, this will increase by this and that. So it is allowed, but just state your assumption, right? If you have, please go ahead.
Requirement 2. Discuss why the market value weighted average cost of capital is preferred to book value weighted average cost of capital when making investment decision. 4 marks.
Thank you. Thank you. Thank you. This is a very good question. I love this because some I would say some professionals are saying, oh, market value weighted average cost of capital is equal, or some maybe chairman or the finance director, right? I say, market value weighted average cost of capital is preferred to book value. Some will say, oh, book value is preferable. Class, book value does not include the current situation in the market. Book value is historical. We will get there. I will just give point, then you develop the point, right? You develop the point. That is 4 marks. Okay, go ahead.
Requirement C. Discuss how the capital asset pricing model can be used to calculate a project-specific cost of capital for JP, referring in your discussion to the key concepts of systematic risk, business risks, and financial risks. 6 marks.
Thank you. Thank you so much. Can you see? The previous lecture we solved, right? They mentioned something about systematic business and financial. These are just 3 marks, 4 marks. You know, imagine the questions. Okay, explain systematic business, financial risk. These are just 3 to 4 marks that you can just, when you see it, you just look at it. Very cheap question. You throw that 3 mark, 4 mark one side, that at least out of 15, 4 is gone. So you are looking for the remaining 14, right? So how project specific cost of capital is another topic, a subtopic under cost of capital, right? Systematic risk. I've explained in our previous lecture that it is unavoidable. It is called market risk. A typical example of systematic risk is the exchange rate, inflation. It's affecting everybody. It is not avoidable. You can't stay with, you can't. Inherent risk. It is. Why business risk are risks that affect a particular sector of the business. A typical example of business risk is the recapitalization policy of CBN. It's only affecting the financial institution. Yes, only affecting the financial institution. Is it affecting the telecommunication, or consumable goods, right? Or yes, or financial services, insurance, just a particular sector. Why financial risk It is the risk that is actually affecting the company alone. A practical illustration is when a company is unable to pay its supplier as and when due. It's a financial risk, or they have high level of gearing. Oh, this company is highly geared. The company is exposed to financial risk. Oh, this company, their cost of sales is actually increasing without a corresponding where are they seeing the, or the cost of debt, the cost of borrowing is actually high. It is a financial risk. So it is only affecting the company. It is not affecting any other company. It is your own company. That is financial risk. Systematic risk is general. Business risk is a particular sector. Financial risk is the only company. But the question now says that discuss how this can be used to calculate the project. We'll get there in today's class. After this question, we'll move to project-specific cost of capital or appropriate cost of capital, right? Or risk-adjusted cost of capital, whichever name, right? Now, this is 20 marks question, right? Esther, are you there?
Yes, sir.
Okay, thank you. So, we already know, so one thing should come to your mind immediately. You see weighted average cost of capital, market value, or after-tax weighted average cost of capital. What should come to your mind is, what are the steps? The sources of finance, identify the sources of finance. They calculate the cost of capital, either equity or debt. The market value of the identified cost of capital, either equity or debt. Then your weighted average cost of capital. That is the first thing that should come to your mind. Then you just go straight to the question. That is why if you read the requirement, it is assumed, you understand the requirement, it is assumed that you've solved 60% of the question because you understand it already. You understand what you want to do. You are different from someone who did not even read the requirement because it is specific cost of it. Just the professional student just see that, oh, it is this, and some students will use project specific cost of capital to determine the weighted average cost of capital, and that is not what the examiner wants. Right after they will say, I saw this question 10 marks, it was tested in this year, I solved it, yes, I did it well, without knowing that the approach to the question. So please always understand the requirements first before you solve. Now, okay, Esther, go ahead, please. Esther, are you still with us?
Yes, I'm here. I read. The director of Jaleyami PLC, an Abuja-based entertainment company, are currently considering the appropriate cost of capital to use in appraising capital investment. It is the policy of the company to assess the financial viability of all capital projects using net present value criterion. You have been provided with the following financial information of the company. Most recent statements of financial position.
Hold on. Thank you. Hold on. Thank you. Thank you so much, Esther. Now, the company based in Abuja, entertainment industry, then are currently considering appropriate which cost of capital are we going to use to appraise our investment, our capital investment. Now, it is not the policy of the company to say that to assess if the project is going to be viable of all the projects using the net present value criteria, which means that which is appropriate net present value. Now, the reason why cost of capital, before in our previous lecture, I gave us the history or what led us to cost of capital is from the function of a financial manager. You have investing decision, financing decision take us to cost of capital. How do we finance this project? Now, you say is either equity or debt. Now, they want to appraise the project. Class, why cost of capital is very important in SFM is because when you want to appraise a project, you will use a DCF, a discounted factor that you will use to discount that project. Now, it could be a project-specific cost of capital, which is subtopic under cost of capital, or the market value, the normal weighted average cost of capital that we know before the specific. So that is why it is very important to take cost of capital before NPV, before the present value. Now, they give us the financial information. Class, can you see? From the financial information, what are the sources of finance? Class, what are the sources of finance?
Equity and debt.
Okay. What are the equity? Equity is what?
Ordinary share.
Okay.
Debt is convertible bonds and preference share.
Good. That's a very good one. Makes sense. Makes sense. Thank you. Now, these are the sources of finance. Now,
What of overdraft?
Can you determine the cost of overdraft? What is overdraft? Overdraft is you withdraw more than what you have in your account. And why? It's because you are operating, you may be operating on current account. So if you withdraw, is there any cost attached to it? So it is an overdraft. They need to pay back. So once the money drops into the account, it can't see it. So it's not a source of finance. All right. It's not. No. Okay. The body. Esther.
Okay. Most recent statements of financial positions.
No. JPRs.
Okay. JP has an equity beta of 1.2 and the dividend market value of the company equity is 1 billion.
Hold on, sorry. Drink water. Just take water. Just take water. Calm down. So DP has an equity beta of 1.2. Now, this beta that is greater than 1. What does that? What is the implication of beta greater than 1? Class, what is the implication of beta greater than 1? What is the implication?
That means that the company is taking more risk than is available in the market.
Busayo.
Yes, sir.
Okay. It means what?
That the risk that the company is taking is more than the available market risk since it's greater than 1.
Okay, that's fine. That's fine. No. And the SDIV market value of the company equity, you can mute your mic. Sonia, okay. Yeah. And the SDIV, it means that 1 point, if it is greater, the company is exposed to high risk in the market. For the company stock, you can make reference to the stock. Okay, it has a very high risk, right? Because it is greater than 1. Now, and the dividend market value of the company equity is what? It's 1 billion. Class, please pay attention. Now, class, this is for ordinary shares. Don't forget that all those sources of finance that you mentioned, it is ordinary equity, ordinary shares, debt. They will give you the market value, either per shares or value, or the debt, the interest, and all that after the financials. Now, and the dividend market value of the company equity is 1 billion. Now, That is the market value. So, which means that when you determine the costs of equity, the next step, we normally determine the total market value, right? Now, the total market value is given to be 1 billion class, and the SDIV market value of the company equity is 1 billion. So this is the market value. So the market value is given to you already. So you don't need to calculate anything. Oh, the value of other shares divided by the nominal times the value, the total value of the market, total market value of equity is given to be 1 billion. Class, are we following? Now, next, the S interest market value of the convertible bond is 168 million. Class, if this 1 billion, let's assume it is not 1 billion. If it is 10 naira per share, you will know that this is not the value. They say 10 naira per share. What is the numbers of shares? But this, it is the value. It is different from the question we solved in our previous lecture, because the SDIV market value is given in per share. But now is the value. So which means that you don't need to calculate the total market value because it is given already. Now, the S interest market value of the convertible bonds is 168 million. Class, are we still together? Can you see that the market value of the convertible bond is also given to be 160? So you don't need to determine the total market value of the convertible bond. Now, in our previous lecture, the question we solved, the S interest market value is per bond. So you can now determine the total market value of the convertible bond. But now in this question now, the total value is given. Now, and the SDIV market value of the preference share is 50 million. Can you see that the total market value of the preference shares is also given? So you can see that from the sources of finance that Joy has already identified to be ordinary shares, they give us all the information. Ordinary shares, from ordinary shares to convertible, from convertible to preference shares. Can you see? Now, class, if this SDIV market value, let me explain this part again. If this SDIV market value maybe is 1 naira per share, you will know that it is not the total market value, but because it is in million, 1 billion cannot be per shares. It cannot be per shares. It is the total. Now, the convertible bonds of JP have a conversion ratio. Class, the convertible bonds of JP have a conversion ratio of 19 ordinary share per bond. So which means that there is a convertible bond. Class, what is a convertible bond? What is convertible bond? Class. Hello? Okay, Taiwo.
Sir, a convertible bond is a bond that can be converted to shares.
Okay.
At the redemption time.
Okay. Okay. Oh, that's a very good one. Okay, that's fine. That's fine. That can be convertible to. Okay. There's one language. There's one terms you need to use while defining it, but that's fine. So any other person, okay? Raji Taufik, convertible bonds. Raji Taufik. Okay. Mr. Moses, Ada.
Good afternoon, sir.
Good
Yeah,
afternoon, Heather.
convertible bonds are bonds that can be converted to ordinary share at the expiration of the bond. They can be converted to shares
Okay,
at the expiration of the listing.
okay. That's fine. That's fine. Uh, Mary, Mary, are you there?
Good afternoon, sir.
Good afternoon.
It's a debt instrument that gives the right to the holder, but not an obligation to convert their shares.
Thank you. Thank you. Thank you. That's a very good one. Thank you. A minute, please. Just want to respond to this message. Okay, that's a very good one. A practical illustration is Ohando. Ohando is planning to raise 300 USD, I think million or dollars, $200, something, 200, 300, let's say $300. What is it called? They want to like convert their debt to equity. Now, if you read the news, if you read it further, it now states that it is an obligation. It is not compulsory, right? It is not an obligation, sorry, that the debt holder should convert. But those debt holder, they would have a meeting with them, and they will say probably they are looking at it that if they convert their debt to equity, it will make sense. Probably, this thing is logical. Probably they are seeing it afar that, oh, Wando will pay a dividend of this, and if I can convert my equity to if I can convert my debt to equity, someone who is expecting interest and principal to be 1 million, for instance, and the person is now calculating, projecting for the future that if I convert it to equity, instead of having 1 million at the date of maturity, I will have 5 million in conversion. Quickly, you will convert because you know that 4 million extra. That is a very good deal. So that is convertible. It is not an obligation, right, for the debt holder to convert to ordinary shares. No, it is not. You are free. You are free to convert to ordinary shares. Now, the conversion ratio of 19 ordinary shares per bond. So this is the conversion ratio. If you don't want to convert to ordinary shares. Now, the conversion date and redemption date are both on the same date in 5 years' time. So if you have to convert, both your redemption that you want to redeem in the future and your conversion date and your conversion will be the same for 5 years. Now, the current ordinary share price of JP is expected to increase by 4% per year for the foreseeable future. Now, you can see that this part is talking about convertible bonds. That is, if they will be a conversion. Now, in that conversion, you will have a conversion ratio. Now, if you have a conversion ratio, then there is a share price. The share price will increase by what? By 4%. Class, I gave one formula. If you remember that I gave one formula to calculate the value of a convertible bond. Convertible bond value, CV. Who can remind us that formula? Convertible bond, CV. Convertible
CV.
value. The formula for calculating convertible value. Okay.
CV
Okay.
is equals to
Is equal
VE
to
Okay.
bracket 1 plus G bracket close raised to
Okay.
power NR.
Okay, that's fine. Now, that is the convertible value. Class. Can you see that there is a conversion ratio, which means that probably what is it called? The debt holder want to convert to shares, and the conversion ratio is 19 ordinary shares. Then the current ordinary share price is expected to increase. So which means that there will be a growth in the share price. Now, the equity risk premium is 5% per year, and the risk-free rate of return is 4% per year. JP pays with this risk premium and risk-free return. Which method are we going to use to calculate the cost of equity? Which method?
CAPM.
Which method?
CAPM.
Thank you. Because is there any dividend with growth or no? You are given an information. Can you see that this question did not say use CAPM? It's from the question you will now see that you have risk premium, you have risk free. Yes, so definitely you have to use, you have equity beta of 1.2. That means you have to use CAPM to determine the cost of equity. Class. So JP pays profit tax at an annual rate of what? 30%. So quickly, what is the name of the company? So there's a solution. JP. So just a solution. JP. Mr. Taufik Raji. Are we safe? Or is a mistake? So JP, the name of the company is JP. The name of the company is JP. So the first sources of finance is ordinary shares. It's ordinary shares. So we have to determine the cost of equity using CAPM based on the information. Cost of equity equals to risk-free plus a minute, please. Okay. Risk-free plus equity beta. Now, we're supposed to have market return minus risk-free. But because the risk premium is given, remember that I gave two formula, right? So since we have risk premium, we will now have market return minus risk-free. So we have here risk premium. Cost of equity equals to, what is the risk-free class? Risk-free. What is the risk-free?
4%.
4%.
Class. 4%. Another name for risk-free is what? What is another name for risk-free?
Treasury bond.
Government
Treasury
bond.
bill or government bond. Thank you. So you may not see it as risk-free. You may see it as treasury bill. So what is the market return? What is the risk premium from the question?
5%.
Right. So what is the cost of equity?
10%.
10%. So the total market value is given to be 1 billion already from the question. Total, please mute your mic. Is that total market value is given to be 1 billion. You can see it from the question. So you don't need to calculate the total market value. Okay. So what is the next sources of finance, class? What is the next sources of finance? Convertible bonds. Good. Class. Convertible bonds. And you should not forget that anytime you want to calculate the costs of convertible bonds, you use internal rate of return to determine the cost of a convertible bond. Right? You use what? Excuse me. Okay, you use internal rate of return to determine the cost of a convertible bond. Then, what are the ingredients you need? What are the ingredients you need to calculate? Because it is convertible bond, it is not a redeemable bond. It is a convertible bond. That is, the equity holder want to like, oh, I want to convert this my bond to shares because they were given the conversion ratios and all that. Now, class, what are the ingredients to calculate the internal rate of return? What are the ingredients? What are the ingredients to calculate the internal rate of return, class?
Market value S interest.
Market value S interest per bond. What do we have again?
Annual
Interest
payments.
payable.
Okay, interest. The interest, okay. Next.
Tax relief.
Okay, tax relief on the interest. Okay, next.
Numbers of years.
The numbers of years. Next.
Redemption.
Total market value.
Redemption. So you know it is not a redeemable bond. It is a convertible bond. So you will not use redemption. You will use a convertible bond or convertible value. Class, are we still together?
Yes, sir.
Thank you. Now, because it is a convertible bond, you can meet your Sonia. Okay, thank you. Now, because it is a convertible bond, you will not use the word redemption. We know it is the principal, but because it is a convertible bond, right? Instead of, don't forget, either redeemable or convertible. So because it is a convertible bond, so you will use what? Convertible value. Because it is what? A convertible what? Convertible bond. So we can have here convertible value, which is the nominal. Now, class, from the question given to us, let's check. Market value S interest per bond. Let's quickly go back to the part of a convertible. The S interest market value of the convertible bond is 168 million. And what we are looking for, what are we looking for? We are looking for the market value S interest per one bond. Why? What is given to us is 168 million. That is the total. Class, how do we determine the market value S interest per one bond? Class, how do we determine the market value S interest? Since we are given the total of 168 million, but we need the market value S interest per one bond. Class, how do we determine the market value S interest per bond? Class. Hello?
Hello, sir.
Yeah, I'm with you.
Yeah, since we have 100 naira for nominal value, we divide it by 160. So that to have per.
is it 100 the nominal value divided by the 168 million, or the 168 million divided by the nominal value?
The 160 divided by nominal value. So that
Okay.
will get per one.
Okay, that is a very good one, right? Try. What happened this afternoon? Village people. Okay. Olalikon.
Good afternoon. So the thing is 168 divided by the
Olalikon, I can't hear you. Hey, okay, you're using the voice.
It is 168 divided by 160. The total value 168. The market value divided by the value of the convertible bond, which is 160 million. So 168 divided by 160.
Okay, 168 divided by 160. Interesting. Wow. You can just mute your mic. Okay. Wow. Class, it is still the same way we normally get. Class, you want to get the market value as interest per one bond, and they give you the total. Class, you just use 168 million divided by the numbers of bonds. Now, just like ordinary shares, just like they give you the total market value of 1 billion. If you want to get the SD per shares, it will be the 1 billion divided by the numbers of shares, so that you get per one. Now, it's still the same thing under the convertible, that for you to get the numbers of bonds, What is the numbers of bonds? The numbers of bonds is what? 168 million divided by the 100, which is the nominal. We give you the numbers. So when you get the numbers, you now say, oh, 168 million divided by the numbers of bonds, so that you will get your what? The S interest per bond. Because whenever you want to use the internal rate of return, you have to get the per bond, not the total value, right? So here we can have number of bonds is equals to convertible value divided by the nominal So what is the value? What is the convertible value, class? What is the convertible value? 160. Should I use 160 million or 160? Class, should I use 160 million or 160? Okay. Okay, let me use 160 divided by the nominal. So what is the numbers of bonds?
1.6.
1.6 million bond, not 1.6. 1.6 million what? Bonds, right? Now, you have the numbers of bonds. So therefore, market value as interest per bond per one equals to what is the total value of what is the total market value? 168 what? 168 million divided by what is the numbers of bonds? 1.6 million bonds. All right, what do we have? What is the market value as interest per bond? 105. Just 105. 105 naira per bond.
Yes.
Good. We are done. You can see the question. You can see I can't want you to unlock. It is not every time, class. It is not every time you will see market value as interest. They will just give you maybe 200, just like the previous one class, the one we solved, right? So the worst case scenario of cost of capital, not project specific, just the first part of cost of capital is this question. This is the worst case scenario question. Worst case that you may see. I can want you to unlock why. They want to test your knowledge. Do you really understand it? It is not to come and write it. Do you really understand it? That is the reason why you are given the total market value of the convertible bond. Then you will now look at it that total market value of the convertible bond, and I need to determine internal rate of return. What I need is just the market value as interest per bond, not the market value as interest, not the market value as interest, the value, not the value. Then you start asking yourself, you ask yourself question, how do I get the market value as interest per one bond? Per one bond. Now, first is to determine what is the number, just like you want to determine the numbers of ordinary shares. Okay, what is the numbers of bonds? Oh, it is 1.6 million. Is that so? Now, if you have 1.6 million bonds, now, and the total market value is 168 million, definitely per bond will be 168 divided by 1.6. Please, are we still together, please? Are we still together?
Yes, sir.
Yes,
Okay.
Sir, with you, sir.
Now, thank you. Now, what is the interest element? What is the interest that you will pay? What is the interest? Don't forget, they always gone body. Can you see it? You will see it beside. Thank you. 7%. So, you know, I will not use 7%. I want to convert this 7% to Naira. 7%. How do I convert to 7 divided by 100? So I want to convert the 7% to Naira. You know, I will not use 7%. So how do I convert it? 7%, okay? Class, how do I convert it? Quickly, class. 7 over 100 times what?
Times 100.
Times 100.
Times 100.
Times the nominal. I want you say times 100. If someone asks you, why do you multiply by 100? It is because the nominal value of the convertible bond is 100 Naira. The nominal value could be 1,000. Right? Now, times this. So we have here 7 Naira. Because this will be at year 0. So you pay interest to the debt holder. So how many years is the convertible bond? How many years?
5 years.
5 years. So you pay interest from year 1 to year 5. Now, the tax relief, excuse me. How many percent is the tax rate? How many percent is the tax
30.
rate? 30%. So because it is a debt, so we can have 30 divided by 100 times what is the interest? The interest is 7 Naira equals to, what do we have? What is the tax relief? What we will deduct from the interest? What do we have? Excuse me. What do we have? Figure.
2.1 naira.
2 naira 1 kobo, right? So it will still be from year 1. You have to deduct it from your interest, right? Class. The numbers of years is 5. Class. The convertible value. This is where we need to work together. I can still lock this question in this part of the convertible. And that is why it is 10 marks. Class, that is why it is 10 marks. In a question where you have convertible ratio, when you have a conversion ratio, you know, class, if it is redeemable, it would have been stated that, oh, they will redeem this at nominal value of 100, or they will redeem it at par. Don't forget, par means 100. If it is not convertible, it will be redeemable. Class. But this is the convertible. They want to convert to shares. Now, if it is redeemable, it will be given just like the previous, the question we solved. It will be stated that, oh, they want to redeem it at par or at 100 naira nominal value. You already know that it is 100. Just put your redemption to be 100, then you go ahead and calculate. But this is the convertible bond. It is not redeemable. It is convertible. So the last principle will be convertible value. Now the question is, how do we determine a convertible value? Right? I gave a formula at the beginning of our lecture on cost of capital. So we'll go back and bring out the formula for calculating a convertible value of bonds. So determination, we come back and say determination of convertible value. So convertible value is equals to VE plus 1 plus growth rate raised to power n times R, where R is the conversion ratio, right? Class. VE. Class, what is VE? Class, what is VE in this formula? VE represents what?
Expected market price of equity per share.
Expected market value of equity per share. That is a very good one. You can say, save yourself stress of expected, right? Just save yourself that stress of expected. We know it is expected, right? Just market price of equity per share. The G is the growth rate. Is the growth rate. N is the numbers of years. R is the conversion ratio. Now, all these ingredients is given to us. Plus, all these ingredients, most of these ingredients are given to us in the question. Like, what is the growth rate? The growth rate of the share price. What is the growth rate? Like the growth rate is given to us. What is the growth rate? Let's start from the growth rate or conversion ratio. Can you see the conversion ratio of 19? Then the current ordinary share price of JP is expected to increase by, this is the growth rate for the future, for the foreseeable what? Future. Right? Now, Conversion ratio, the growth rate is 4%. Please mute your mic. The numbers of years is 5 years. Conversion ratio is equal to 19. Now, what about the market value of equity per share? How do we determine the market value of equity per share? They say it is market value of equity per share. Market price, sorry, of equity. Per share means per one. Class, how do we determine the market price of equity per share? Class, what we were given in the question under equity is the total market value, not the market price or the market value SD per share. What we're given is, it is equity. You just go to the equity part. What we're given is what? The SD market value, not the market price per share or the market value SD per share. Assuming we have here market value SD per share or the market price per share, would have just come here because it is market price of equity per share. We just come to the equity, just pick that figure. But because what we're given is value, we need per share. Class, we need per share. Class, how do we determine the market value of equity per share? Since we were given the total market value, so how do we determine the total the market price per share? How do we get per one of this 1 billion, class?
So the first thing is
total market value of equity share divided by number of ordinary share.
No, you will not say total market value. No, you will say the value of ordinary shares. Get the numbers of shares first. The value of ordinary shares of 200 divided by the nominal value, so that you have what? The numbers of shares. If you have your numbers of shares, you can now say, oh, the 1 billion divided by the numbers of shares, so that you will have your market value or the market price of equity per share. Class, am I communicating? Are we still together?
Yes, sir.
Thank you. So value, we already know this now. Okay, let me just write it out. Value of ordinary shares divided by the nominal. So what is the value of ordinary shares, class? What is the value of ordinary shares?
200.
1 billion.
1 billion.
200.
200.
Okay, I'm coming. Let me do it this way. Okay, I think need to separate it. Don't worry. Let's start from let's get the numbers of shares. Let's get the numbers of shares. 200 million divided by the numbers of shares, which is the nominal value. Sorry, what is the nominal value of equity?
1 naira.
What is the nominal value?
Naira.
Okay, 1 naira. Okay, 1 naira. So what is the numbers of shares? The numbers of shares is 200 million shares. Who is that now? Mute your mic. Okay.
The nominal value is 1 naira, not 1 million.
Oh, thank you. Thank you. Thank you. So this is the numbers of shares. Class, this is the numbers of shares. So we need to get, since we're given the 1 billion, so 1 billion divided by the numbers of shares. I think we have to write it in full so that we'll not say, it is this, it is that, it is this, it is this. Should I write it in full, or I will just write 1 billion divided by 200 million? Then we'll move from there.
1 billion.
I should just write.
You can just write 1 billion. So writing it in full.
Okay, 1 billion. Okay. Divided by the 200 million shares. What do we have?
5 naira. 5 naira per share.
5 naira per share. Thank you. You have to include this per share. Class. So we can now solve for our convertible value. So convertible value, CV equals to VE 5 naira plus 1 plus growth rate 0.04. The numbers of years is 5 raised to power 5.
So it's not plus, so see, I don't think it's 5 naira plus.
Okay. That's fine. Thank you. Oh, excuse me. So times 19. What is happening here? Right. So there's no plus, right? So please check the formula. I think there's no plus, right? So that's fine. Okay. Please, what do we have? What is the convertible?
115.6.
1 what?
15.6.
115 naira.
0.6 kobo.
6 kobo. Right. Now, can you see that this is the value? I can want you to test your knowledge if you really understand how to determine a convertible bond, the value of a convertible. Class, if it is redeemable, you don't need to. If it is a redeemable bond, you don't need to go through. They will give you that. They will tell you that, oh, the redeemable bond is at par. Par means 100. Oh, the redeemable bond has a nominal value of, or the nominal value is equals to the nominal value of the bond with the redeemable bond. They will just shall speak that their grammar. You will know that the redeemable will be equals to the nominal value, or they can say, okay, the redeemable is at par, right? The redeemable is at what? The redeemable is actually what? At par. That is 100. So we just put it there and move on. But because it is convertible, you need to get a convertible value. If it is not given to us, in this question, the convertible value is not given, right? It's not given to us, but we need it sometimes. But most times, the convertible value will not be given. You have to calculate the value of a convertible bond. Now, convertible value per share is what? 115.6. So we can now determine our internal rate of return. Is that not so? All our ingredients is now complete, right? So we can determine what? The internal rate of return. So how do we start the internal rate of return? Internal rate of return. So we are starting with that positive. So which percentage will give us positive and which percentage will give us negative, class? Don't forget it's trial and error. Which percentage will give us positive and which percentage will give us negative, class?
2 will give us positive.
Okay.
10 will give us negative.
That is a very good one. So you can see, for the purpose of the exam, you don't even need to do trial and error. You check if this one is this. No, just do what? You move on. Just check. 2 will give positive. right? The lower the DCF, the higher the NPV, right? The higher the what? The higher the NPV. So, items. Taiwo, Zain, do you have a question for me? Taiwo.
Yes, I have a question, sir.
Right.
Yes, sir. Thank you, sir. Sir, I think I'm a bit confused about the total value of equity shares, the one given to us in the statement of financial position, which is 200 billion, and the one given to us in the additional information, which is 1 billion naira. So what's the difference between the two, sir?
Taiwo, I've explained this in our previous lecture. Do you watch the? Okay, that's fine. There are two different things. Market price is different from nominal value. Nominal value is a value place, is a face value of ordinary shares. Is a face value. The nominal value could be, it's not a market value. It's just like you are talking about book value and market price. You are talking about the historical cost of an asset, and you're talking about the current value of an asset. Are they the same? They are not the same. So now pick the historical as the nominal. Pick the current as the market value of 1 billion. So there are two different things. So if you go to the NGS today, now, you check the NGS, you check maybe Fidelity, or you check Jitco, or you check some other. The current market price is the market price. If the market price is 2 naira, let's say, I don't know their current market price, maybe it's 2 naira. That is the market price. What is the numbers of shares traded as at yesterday? 2 times the numbers of shares traded yesterday. We give you what we call market capitalization. In London Stock Exchange, they call it what is it called? Total outstanding shares. Right. So there are two different things. Thank you. Are we good?
Yes, sir. It's clear. Thank you, sir.
Thank you. So now, internal rate of return. Yes. Oh, away. Okay. What do we have again? Items. Cash flow. Please write it in full. Always write it in full, please. Okay. DCF, right? DCF. Maybe 2%. We are starting with 2%. PV, which is present value. At year 0. Market value. Please don't cram SFM. Understand SFM. If you understand it, there is no how I can want to bring it question. You will find a way out. You will write something. It's not just ordinary thing. You will write what you know, like what you understand by that. If you look at last diet, I think question 7, the last question was talking about capital asset pricing model. Sometimes when we are in class like this, I can use 30 minutes or even less than that, maybe 15 minutes to 10 minutes to talk about capital asset pricing model from the beginning to the end. Most especially on unsystematic, because I know question will come. Sometimes question will come, and the question will say, okay, explain this thing. Right? So imagine you have 6 marks on that. Maybe the question is maybe 15 marks or 20 marks. You are good. Then you have to look for how you will get others. Right? Now, what is the market value as interest? What is the market value as interest class? What is the market value as interest? Away.
105.
Am I the only one in this class?
105 naira.
Okay, 105. That's fine. This is 1. So we can have here 105. So we have the interest year 1 to year 5. So what is the interest? 7 naira. Please use annuity to calculate year 1 to 5 quickly. Year 1 to 5. What do we have? Do we have anyone who did not know how to use annuity? You can check your 4-figure table. So what do we have, class?
4.71.
4.71.
Now, I think I checked. Where is Kende? Kende, are you in this class? Okay, no. Yes, no. Now, always use 3 decimal place when it comes to this year. What do you have here?
4.713.
4.713.
13. Okay. So, what do you have when you multiply? What do you have?
32.991.
Okay. 32 point what? Sorry.
991.
Okay. 991. Okay. Next is 1 to 5. Tax relief on interest. So what do we have here? I think it's 2 point something.
2.1.
2.21. So we have the same thing to be 4.713. So what do we have here, class?
9.897.
9.897. So the convertible is just like your redemption, because this is not redemption. This is not redeemable. It is convertible. So at year 5, just like principal, right? So you have the convertible value, which is your redemption. It's not redemption, yes. Sorry, you call it convertible because it is a convertible bond, not a redeemable bond. So, what is the value of convertible?
115.6.
115.6. So, please, what is the discount factor?
0.906.
0.906.
Multiply, what do you have?
104.7.
104.7. So, what is the MPV? MPV. I can copy this. So what is the MPV? So I can change this to 10%. Can change this to 10%. To 10%. So this will change. What is the NPV class?
22.794.
Okay.
Positive.
22.794. 794. This is the positive NPV. Okay, please, what is the annuity from year 1 to 5 year? What is the figure?
3.791.
3.791. Multiply. This we have here 3.791. So what is the DCF?
26.
The first one, right?
First one is 26.537.
Okay. 26.537. What do we have next? Quickly, class.
7.961 in brackets.
7.961.
7.961. So what is the DCF for this? DCF?
$0.386.
0.386. So what do we have?
Sorry, sir, that is 0.620.
0.620. So what do you have here?
$71.672.
71.
0.672.
672. Okay.
So the discount factor is 0.621. Yeah.
Okay. So what is the NPV?
71.788.
71.788.
788. Okay, no, that is the PV, not the NPV.
Minus 14.752.
What do you have?
Minus 14.752.
0.7 minus 14.72.
52. 0.752.
0.752. Okay. Okay. So you can actually, okay, that's fine. Okay, so positive and negative NPV, just three. I think it is just three sources of finance, so it's giving us a headache. Right? I beg. So let me quickly copy. Who is that? Let me quickly copy the positive and negative NPV formula. Please solve for it. Calculate the positive and negative NPV.
Sorry, sir.
Yes, ma'am.
The computation of the last one, this 0.621 times 115 is 71.788.
Hold on. Okay, I'm coming. Let's see. Okay, sorry. I'm with you. What do you have here? The last figure is what? 71 point what?
788.
788. So is this correct? Is this correct
Yes.
now? Okay,
So the MPV will now be 14.636.
636. Okay, that's fine. So what is your MPV, please? What is your what is the cost of convertible? Quickly, please. What is the cost of convertible? Cost of convertible, please. Lower rates. Just use 2. Positive MPV. Positive MPV. What is the positive MPV?
22.794.
22.794. Positive 22.794 plus the negative 14.636. Higher rate. Higher rate is 10 minus lower rate is 2. So class, what is the cost? What is the cost of convertible bond?
6.87.
6.87. 6.87% or can you 7%? So the total market value is given already, so we'll just go and pick it off. Please mute your mic. Who is that? The person should mute his mic, please. Total market value. Jamil. So the total market value is given to us already, so we don't need to calculate anything for the convertible. It's given to be is 50 million, right? 168 million, sorry. Right, class? Are we still together? Yeah, 168. 168 million. So are we good? You can see just only for convertible, only for convertible. We saw from this part to this. So it is what it is, class. It is what it is. The only problematic here in this question, right? That is why it is 10 marks. Is this convertible bond? Right. Is this what? Convertible bond. Olalikon, who is this? Namesake. Olalikon, do you have question? But I must see. Class, are we good?
Yes, sir.
Okay, that's fine. So we move. Which other sources of finance do we? Other sources of finance? Which other sources of finance do we have?
Preference shares.
Okay, preference shares. So quickly move to the preference shares. Preference shares. Preference shares. So class, what is the cost of preference shares? The current equals to the current dividend of preference shares divided by the market value SDIF. Don't forget this, all this SDIF, market value SDIF that you use to get your cost is usually per share, not value, right? So now class, cost of preference shares equals to, what is the current dividend for preference shares, class? The current dividend of preference shares is what? Because what we're given in this paragraph, is just the market value. The total market value of preference shares is given to be 15 million. So class, what is the current dividend for preference shares? What is the current dividend for preference shares, class?
5 naira.
5. It is not even 5 naira. Okay, Wally.
5%.
It's 5%, but it's not 5 naira. Do you know?
Okay, yeah, it's true.
It's true, yeah. Yes, thank you. It's Kobo, thank you. Thank you. Thank you. So please, it is what it is, right? Okay, that is well done, Wally, well done. Makes sense. So 0.05 divided by, now the market value SD per share. You know, the market value SD, it is per share because the current dividend is per share. The current dividend is per share. There are two ways you can solve this question, right? You can get the total value of the current dividend for preference shares, then divide it by the total market value of 50 million. Or you get your current dividend per share. You divide it by the market value of SDIF per share. So per share we go with per share, or value we go with what? With value. Class, am I communicating, please? Am I communicating? So since we're given the total value for this, so let's get the per share, the SD market value per one share. So if I want to get per one share, I already have the nominal value. I already have 80 divided by the nominal. We give you the 80 million shares. You divide 80 million shares by the total. You have 50 million divided by 80 million. You have your what? The SD per share. So we can have here. Okay. Market value. Let me show you the workings. Market value SDIV. That's now. Since you need to use the mic. Jamil, I will remove you from this class. So, Jamil. Okay. Market value SD. Market value SD per share. All right. It's calculated as the value of preference share is 80 million divided by the nominal value of preference share, which is 1 naira. This will give you 80 million shares. So equals to, what is the total market value as DIV? I think it's 150 million, right? So 150 million divided by the 80 million shares. Class, what do we have?
It's 50 million. Not 150.
Oh,
50 million.
Thank you. So what do we have? Quickly, class, what do you have?
0.625.
0.625 per share. So since you have your current dividend to be per share, so the market value of SD will be per share 0.625. So what is the cost of preference shares? What is the cost of preference shares?
8%.
So why are you dividing the percentage by the variety of time?
How now? Who is asking that question? Who is that? Is it Joy?
Yes, it's me.
Yes, it's Joy.
This is 0.05. This is 0.05. Joy. It is not percentage, right? We have converted it. If you check the previous lecture under the preference shares, we did something like this. So just go back and check, okay? Just go back and check. So anytime you are not given, maybe in this body, you're not given the preference share. Ideally, on the norms, they're supposed to give the current dividend for preference shares, right? They're supposed to give the current dividend for preference shares. But if it is not given here, see, this is your percentage. It is not 5%. It is 5 kobo. And I prove it. I prove it in our last class, right? Please, you can check how we arrive at 5 kobo. But when you see 5%, if you see 5% is 5 kobo. If you see 7% is 7 kobo. Do you get?
Yes.
Thank you. Now, we should not equally forget this. We should not equally forget that this market value given to us, Ican can decide to twist this question again. Instead of giving SDIV, they will tell you that the market value is this, and the company declared dividend. You should know that dividend is yet to be paid. For you to get the market value, it will be the market price. For you to get the market value SDIV, or the market value SDIV, it will be the market price minus the outstanding dividend. Please, we should not forget these things. That if we have here, instead of SDIV, they can still change it to be the market price or the market value of maybe the market value of preference share, or the market value of ordinary shares is this 1 billion, and the company declare a dividend of this. You should know that that market value or that market price, it is not SDIV, it is cum div. You need to remove the outstanding dividend, class, so that you will arrive at what the market value SDIV. Class, am I communicating, please? Okay.
Yes.
Okay, now, what is the cost of preference shares? What is the cost of preference shares? What is the cost of preference shares, class? Hello?
0.08.
That is 88%. 8%. When you multiply it by 100, you have 8%, right? Okay. So because Naira has cancelled Naira already, do you get times 100? So 0.08 or 8%. So the total market value of preference shares is given already. We don't need to calculate market value. The market value is equal to 150 million given to us. Okay, class. What's the next step? WACC. We said average cost of capital. So we can have, there are also other methods, but let's just use this. When we get to the other parts, we'll use the other one. Right. What is the formula? Items, total market value, cost of capital, ash total. Okay, from ordinary shares, what is the total market value of ordinary shares? 1 billion, right? Should I write 1 billion or I should just leave it? We should maintain. Class, should I write the 1 billion or we should maintain this? Or I should write 1 billion? Which one?
There's 1 billion. 1 billion in, 060.
Is this is 0?
0.
How many 0?
9.
9. So what do we have here? What is the cost of capital?
0.1.
0.1. Next is convertible. So what is the market value of convertible? The total market value of convertible?
168.
168
million.
Okay, what is the cost?
8% collaborative.
Okay. Okay. How many percent? So you're not writing. Okay. 0.07. 6 point something. 6.87 or 7%. So preference shares. So what is the total market value for preference shares?
50 million.
50 million. So what is the cost of preference shares?
8%.
0.08. So class, what do we have here?
100 million.
100 What do we have here?
$11,760,000.
So what do we have here?
4 million.
4 million.
Please on to total the total market value and hash total.
And
so WACC equals to
Total market value.
Yeah, what is the total market value?
1,218 million. 218 million.
Okay, what do we have here?
115 million. 760,000.
So 115,760 divided by 1,218. So what do we have here?
9.5%.
9.5%. So this is just how many marks? 10 marks. So 10 marks took us about how many hours?
1 hour,
Close to
50 minutes.
close to 2 hours now. Interesting. Right. It is because we are doing it together, actually. Right. So individual can actually do it maybe 30 minutes, less than 30 minutes. Right. So class, it is what it is. We are done with the A part of this question, which is 10 marks. So there's no any assumption. Right. No assumption. So do you have anyone that have question? If you have question, please, you can mute your mic. So if there's no question, let's quickly move on. So discuss why market value weighted, what we calculated now is market value weighted average cost of capital or post-tax weighted average cost of capital, because you can see that the weighted average cost of capital include the market value, right? It takes consideration of what is happening at the present now, right? So what is the difference? Who can give us? This is 4 marks, right? Discuss why market value weighted average cost of capital is preferred to book value weighted average cost of capital when making investment decision.
Okay,
Class.
let me try. The market value take consideration of what is happening in the market, while the net book value is historical cost.
Historical. Okay.
Actually, yes, that.
Okay, that is one. Second, in terms of investment decision, if I want to use now, in terms of investment decision, the market value weighted average cost of capital, it shows the real NPV, whether positive or negative, for investors to make a decision. Why book value is not what weighted average cost of capital, if it is being used to discount a project, is not realistic, because a project that is supposed to be negative NPV the book value weighted average cost of capital, we make it to be a positive NPV. It's just like when you discount with the market value weighted average cost of capital, you have positive NPV, right? When you discount with the book value weighted average cost of capital, you will have negative NPV because the book value, yes, because the book value does not consider the current market value. Now, sometimes a project that's supposed to be negative NPV, the book value will say it is because you use the book value weighted average cost of capital to discount the project, it will now show a positive NPV, which means that the book value weighted average cost of capital may overstate the NPV. Class, are we still together, please? Who is against me in this class?
Oh, we are nobody.
Okay. Mary, you wanted to say something?
I wanted to say you should retreat. Like, please go back again. I did not get the point.
Okay, that's fine. That's fine.
Thank you. Thank you.
Yeah. Now, I'm trying to explain. You can trace book value and market value. Just relate it to historical cost of an asset and the market value of an asset, current market value. Right. Now, back to the market value weighted average. Now, the market value weighted average cost of capital consider the current situation. It consider the current things, something that is happening live, not unlike a book value, just like what Esther actually explained earlier. Right. Now, in terms of decision, the book value weighted average cost of capital shows the real net present value. Why? Right? Why the book value may not show because the real net NPV, because the book value is historical. In addition to that, the weighted average cost of capital, if you actually discount a project with a weighted market value weighted average cost of capital that is positive NPV, when you want to discount a project with the book value weighted average cost of the book value weighted average cost of capital, that same project that is positive NPV, it may be negative NPV under the book value. You can see that it is opposite. Now, a project that has a negative NPV, all right, using the market value weighted average cost of capital to discount it, the book value will say, oh, it has a positive NPV, which means that the book value weighted average cost of capital is overstating the investment, right? Which may mislead the investors. So the preferable, right? The preferred is the market value. Class, Mary, are we still together?
Yes, sir. Yes, sir.
Okay. 4 marks. Discuss how the capital asset pricing model can be used to calculate the project specific. Oh, when we get to project specific cost of capital, you will see how the capital asset pricing model is used to determine the project specific cost of capital. By then we can now come back to this question. Referring your decision to key concept of this, I've explained this at the beginning. So this is 6 marks. Total marks is 20. So distinguished professional colleagues, are we still together?
Yes, sir. Yes, sir. I want to request something.
What is the request?
The cost of capital. Can we have all the video in this thing for YouTube, so that I want to recommend it for somebody?
Okay. It's even as we speak now. all the videos on SFM. Okay, on only cost of capital.
At least you should be doing it little by, because the guy is in the factory now. He's driving seriously, but he's interested in this thing. So
Okay, no, just share the playlist of just share the playlist of
I will request in your inbox.
No. I don't have anything to just check. Just copy the SFM playlist. Is there? You will see it. Introduction to cost of. The person should just check introduction to cost of capital. Is there already? So anything that has to do with cost of capital. Do you understand?
What about these solutions? How can we?
No. I can't give this solution. Just have the solution that I want to give out. I've as promised in the first class, right? I've actually included it in the what is it called? In the material. We check the first solution. The second question that we solved will not be there. The third one, which is this, will not be there. So you have to go back and watch it. You get go and watch it on the YouTube. There's a purpose for that. It's not because I want you to go to the YouTube to watch. There's a purpose for that. Because experience has shows that this same question that students will ask, it is something that if they watch the video, they can get all the questions they want to ask from that video. But because we want to do scanning, some of us want to do scanning, we just look at it, say, okay, this is how you arrive at this answer. Okay, no, you must write. Do we get? We must write. So that's it. So you can check. It's on YouTube now. You can check the playlist. Yeah, it's there now, so you can check it.
I beg you, please. I also have a request, please, concerning the assignment you gave us. Actually, I was trying to do it, but I was kind of busy. But I was a little bit confused concerning some items there. I don't know if possible you can just help us to go.
No, I can't. I won't solve that question.
Not to solve. Maybe there are some like area that maybe you just explain them. We don't go and do it.
No, I need to know the area you want. I need to know the area you want me to talk about. I need to know the area.
Let me do it. Then I will send it to you.
Okay, Mr. Abraham.
Okay.
Thank you very much. But I want to say something concerning the assignment. You said we should not send to you individually, that we should send to the group. But in the group, you'll not be able to, okay, now, if I did an assignment and it's wrong, how do you get back to me and say, oh, this is what is wrong in your solution? Because we just pasted and nothing was.
Don't worry, you don't know. Do you know that I checked that assignment? I checked it. Wait, Mr. Peter. Mr. Peter, are you still in this class?
Yes, sir.
Yeah, that's your assumption. I don't know. I'm coming, Esther. That your assumption that you gave me, you gave a formula of profit after tax divided by opening shareholders funds, and I see from your calculation that you deducted your dividend from your retained earning. You know, for a novice, right? For a novice, I will look at it that, okay, if, for instance, I don't know anything about cost of hand, I want you to solve this question for me. That's minus that you deducted from this. I will ask you a question. So you're supposed to give a breakdown on why do you have to deduct dividend from that retained earning. But you made a very good attempt. That is a very good one. And I think Sonia as well, right? She did a very good job. I think she did not, I don't think she finished that assignment. And wait again, I think someone again, what is this? What is her name? Coming. Let me check. Wale, I need to know the area you want me to come in. You you get.
Yeah, no problem. I will get back to you.
No, not my DMO. You know now. Just paste it. I will look at it. I will see it. Delight. Right. Delight as well. I think it's just 3. Imagine we have about, in our last class we had about I think about 30 something or 40 something participants, and just just 3 attempted the question. It's not supposed to be like that actually. right? So you have to go back to it. It is what you can do. You have to go back. So that question, I actually cut it out. That question is 30 marks question, right? It is 30 mark questions, and I think one of the ACC or Ican, right? So I removed some part of the project specific cost of capital. Then this capital asset pricing model and Gordon growth model is 10 marks. I think, is it 10 marks? I think 10 to 15 marks thereabout, right? And there is a purpose for allotting that 10 marks or 15 marks. So this just two. There's a purpose for that. It's a very technical question. You have to, most especially using the Gordon. The capital asset pricing model is not the issue. It's just the Gordon's part of it, right? Gifts. Sonia and Mr. Peter, you guys did a very good job. Makes sense. Right? Makes sense. Any other question, please? Madam Sonia.
Yes, sir. I don't know, maybe from the typing error, the question was not, the long-term loans was not given.
So what did you want to use? What do you want to use the long-term loan for?
No, for the total market value. The total market value is assumed.
The long-term loan. Oh, okay.
Yes.
Okay.
It was not given. So what I did was that I did 7,790. I sum it up, then the balance up.
Okay. The balance, because if you had this two, we not give you 7,000. Okay. Yeah, that is a very good one. So the question, I didn't see it. So I just copy it. Imagine, copy and paste. So what is the difference?
635.
635.
Okay, 635. Okay, that's fine. Thank you so much. I think
Sir, sorry, I don't know, but seriously, that Gordon's is really confusing.
No, it's not confusing.
Seriously, I battle with it very well. I don't know that is correct.
I saw it. He didn't finish it. I saw it. He didn't finish that question. Well, that's fine. I think I have to reserve some questions. There are some questions I will not do. I can't do all the questions on that cost of capital. We just have to move, right? And maybe in intensive class, we'll look at this question. Maybe it will be part of the question we'll solve. Right. So, any other question, please? Taiwo.
No questions, sir.
Okay. So, me, I'm tired though. We're supposed to. Yeah, thank you. We're supposed to move to project specific cost of capital, but the energy is not there. So the way I want to explain it, it may not come that way, right? So let's just leave it. Our next class, we look at the project specific cost of capital. Please go back to the YouTube, watch it, digest this question.
Please, concerning the material on the one Mr. Morofu is taking, are we waiting for him to finish before we get the material from him?
Have you checked your drive? Have you checked your drive? Check your drive. You will see strategic management. Check your drive.
No, I'm talking about the
material. That is the material now. You'll be updating it on a weekly basis. I think I'm supposed to get his he's supposed to send his what is it called, scenario question, right? Scenario question that we'll look at maybe on Monday. I think you guys have him on Tuesday. So well, you get everything. Just keep checking the folder. We'll update our material on a week-on basis.
All right, thank you.
Yeah, you're welcome. So for this project specific cost of capital, I still have some other questions to add. So you may not see it there now. When we meet on, when is our next class? Wednesday, right? We meet on Wednesday. Is it Wednesday? we'll meet on Wednesday. We'll start with your project specific cost of capital. So I think we have to go, class. Right. So thank you so much, everyone, for joining. And don't forget, grace does not work in an isolation. You just have to work for it. Honestly, you just have to work for it. You can't sit down. You can't keep saying by God's grace you pass it. By God's grace you pass it. By God's grace you pass it. Do you make effort? That's it. If next gen professionals, if we did not put in more effort, our first diet would have been the diet that it will discourage us, right? We may not be where we are today. It is because we put in efforts and we see the grace actually, right? Because that is what I will call it, is a grace. Because if a center can be able to establish within a year and have 68 qualified chartered accountants, and it is a lot, right? So we want to achieve 100% this diet, and I believe we can, right? So let's work together so that we can be able to achieve the objective. So have a wonderful weekend. Thank you so much, everyone. Thank you.
Thank you, sir.
Yeah, thank you.
Thank you.
Yeah, thank you, Joy. Thank you.